this episode of Geared for Growth, we're joined by Rishi Bajaj, a property investor and buyer's agent who helps his clients build high-return portfolios that actually align with their personal and financial goals. Rishi's story is one that many investors will relate to. He started as, in his own words, just an average bloke, renting, working hard, and stumbling his way into a property investing strategy without a clear plan. His first purchase, right before the global financial crisis. And like so many of us, he thought he'd made the biggest mistake of his life, until that so-called mistake became the foundation of an 8-property portfolio across New Zealand and Australia. In this chat, Rishi shares what those early missteps taught him about resilience, risk, and the importance of understanding your why before diving into the what of property investing. We unpack his 3 key portfolio stages: acquisition, stabilization, and consolidation, and how he helps clients balance ambition with realism in today's shifting market. He also gives us his take on where he's seeing strong performance across regional Australia, the fundamentals driving those markets, and why mindset, not money, is often the biggest barrier investors are being held back by. Here's Rishi. Rishi Bajaj, thanks for joining me on Geared for Growth.
Thanks a lot, Mike. Thanks for having me over here. It's really an honor to be on your show.
Well, it's very kind of you to say, but the privilege is ours because we know we've got a great episode with lots of things to unpack. But let's start with you, your own story, your property journey. How did you get started, and maybe some of the lessons that you learnt along the way that really helped the way that you communicate and add value to your clients?
Well, mate, if I start with my journey, to be honest, nothing special. I was just an average bloke. I've traveled a lot in my life, as my dad was in the army. And I came to New Zealand as a student, studied over there, got my dream job. So just an average bloke. And that's when my interest in property started. And I started looking, all right, what's this? Open home boards in my street. What's happening over there? Let's go and have a look. Started understanding the concept of property.
Yep.
And that's when we had a chat with the families, and I was single, I was not married at that time. He said, hey, you know what? That's perfect. You don't have any responsibilities. So, why not just go and buy something? At that time, there was nothing like strategy, portfolio planning, equity. What's my next step? What's my foundation property? There was nothing like that. You look at a house, numbers make sense, you buy it.
Yep.
So back in 2007, that's when I bought my first property.
Mm-hmm.
Yep.
What are we talking? Describe that for us.
Okay, so back in Auckland, this was it was just a house, a kind of a duplex, one of 2 houses. So mine was it was a cross lease. Mine was the first, was on the front. Not a biggie, just a 2-bedder, 1 bathroom, kitchen, and a small garage. That's it. That's where I started. And I was hardly bought it for 310,000. That's it.
And what was sort of the process of purchasing that particular property? Obviously, you were over there, you landed your dream job, which I assume meant, you had the salary to invest. What made that kind of tick all of the boxes in the beginning, or were you not that sophisticated when we're talking on the first one?
No, it was, as I said, I was single, young, every Friday just going out, party like all my friends. But then I had family. I had some really good, sensible people over there who would talk me out. Yeah, it's good. You should always maintain a balance. We're not saying you should not enjoy your life, but what I understood is having investments or having property is a point of gravity. It's a central point, and then things revolve around it.
Yep.
And that's what hit me, and I knew that I can buy something, and if I can, then why not invest in it?
Yep. And how did that property perform, and how did that kind of inform your journey from there?
To be honest, after buying it, I thought I did my biggest mistake of my life.
Right.
Because I bought it in a GFC.
Yep.
2007, 2008, that's when we were entering into that.
Yes.
Everybody said, wait and watch. I bought it for 310. After 6 months, the valuation came to 280.
Oof. Yep.
And I was hitting my head, interest rate hitting somewhere 7 to 8%. And I was hitting my head on the wall that why did I invest? I should have never done that. But fast forward, couple of years down the lane. It was a forced consolidation. We had to sell that property to the council, and I sold it for 400 plus.
Okay. So
Yeah,
it
not
wasn't a
bad.
disaster at all.
Nah. And you know what? Just 1 year after, I bought the next property to it.
Yep. All
The
right.
moment we came out of GFC, we were doing good. I just bought because then I got the whole lot for myself.
Right. And so fast forward to today, what does your sort of portfolio look like as much as you're comfortable with sharing?
Absolutely. See, what I believe, it's not about having 10, 20, or 30 properties.
Mhm.
What I believe is having a good and a healthy portfolio. No matter that healthy portfolio is 3 properties, 5, if you're comfortable with 30, why not be my guest?
Yep.
So I built my portfolio in New Zealand. I've got a couple of properties over there. I've got those two. I had to sell one. Then I got my third and fourth property there. Then I came to Australia. I bought my property here where I am now in Sydney. When I came immediately, I didn't have to wait much long. Within 1 year, we bought a property. And good, we did it. Thanks to those back in 2017, 18. If
Yep.
not, we would be struggling today.
Yep.
And then we moved on, and I bought one property in Queensland, that's Bundaberg. Then with one, I've got a semi-commercial property in Ipswich. And then we got one property in Adelaide, and now I'm looking for, and then Perth is where I'm just looking. So coming to approximately 8 properties at the moment.
Yep.
And I've got some overseas investments in India also.
Interesting. So talk to us about the dream job and of course property as the hobby, or at least the smart thing to do when you've got I presume a good wicket, and the transition to you becoming a buyer's agent yourself.
So I was doing well in New Zealand. I was working for an oil company. Things were going great. Got a kid over there, and I loved New Zealand. In fact, last week I was there, and I'll tell you why I was there after a bit later in the show. So yeah, working for an oil company, and then suddenly things changed. The company was exiting out of the country. They were selling it, and I moved to. First of all, I was in Singapore, and then I was an option: do I go and settle in Singapore, or do I come to Australia? And eventually, I was pulled into Australia for Celtics.
Right.
So it was settling it in, was taking time. Hats off to my wife, to be honest. She had a great job. She was working for a big company, a big bank over there, partners there, and yeah, she supported me, and she came here. We continued the journey working for the oil company, but that passion of property was always there behind my back. In fact, I do remember approaching some purple property. I haven't forgotten the name. They were doing, sorry, I don't even know the full name now. It's been ages back. This is 2018, 17. It was purple brick or something like that.
Yep.
And there was the idea that, oh, maybe I become a real estate agent and start going into that. All right.
Yep.
Then again, it just has nah, that's not me. So I just started, you know what, I'll start investing again, go on my journey, buying some properties. Then sitting in the office, friends talking, they're always talking about property. That's
Yeah.
what I noticed. More than New Zealand and Australia, or maybe it was just time of the year that everybody's just talking about property.
Yep.
So that's where we used to have conversation. I used to share my story with them, and a friend of mine said, "Oh, I'll never buy a property." I said, "Why?" He said, "If I lost my job, I'll never pay the mortgage, so I'm renting."
Yep.
And I said, "Mate, you've got a great landlord." He said, "Why?" I said, "Because if you lost your job, he's definitely going to take your rent. How are you going to pay them?"
Exactly. Exactly.
I said,
I don't know what the difference is.
at least with bank, there are things like hardship and other programs or insurances where you can go to them.
Mm.
But your landlord is not going to feel pity on you, mate.
No.
Today, that guy has 4 properties.
Right.
So at times it's just that one piece of advice, or just something you talk. What clicks you and what picks you up.
Yep. Most people probably look at buyers agents as having a lot of the answers or being quite successful in themselves, but many of the best ones that I've interviewed have made plenty of mistakes and have some scars and cite some of those issues or those bad deals as really good teachers. Was there a defining moment or maybe a deal that went wrong or even right that kind of changed your approach to investing that enabled you to sort of grow to that size of a portfolio?
Oh, absolutely, mate. I don't. I believe every successful person who has been here. I mean, I'm driving to it. It's there are mistakes. You learn from it. Uh, that first property I bought, it was a forced consolidation because I did not do a due diligence. I bought it on the main road.
Right.
If I had bought it one street behind, today those properties over there are more than 1.5, 1.4 million.
Mm.
Unfortunately.
Yes.
Then a couple of mistakes I did. I did a home and land package, which is again not a bad deal, but then the construction got delayed. When the occupancy certificate came, it was not unconditional. It was conditional,
Right.
and due to that, the other properties in that area quickly got rented out. Mine also got rented out after a while, but it was a low rent because everything started filling up.
Mm.
And that's why I was telling you why I was in New Zealand last year. So part of a portfolio building, there are three phases we call about. One is acquisition. You
Yep.
buy quickly, as much as you can, as quickly as you can. Stabilization, let economy do the heavy lifting. So you've done your bit. You're paying the mortgage, you're paying the deposit, you're taking care of the maintenance, you're doing your hard work,
Yep.
and the property is also growing. Then comes consolidation. Now, back in 2021, New Zealand was a hot market. We had a great decision. I was being told sell the property. It's a great market. Just sell it out. I did my numbers. I said, you know what? I don't need to sell it.
Mm-hmm.
Why do I sell a property to buy a property? 2022, sorry. 3 years down the lane, economy didn't grow.
Yep.
So if I would have sold it at that time, got that money and invested somewhere, it would have grown. So at times consolidation is also very important
Mm-hmm.
because you can't draw the equity, the market has capped, or the property is asking a lot of maintenance.
Yep. Do you think
So
one of the challenges that we have there, Rishi, is that we've kind of been indoctrinated, and maybe this is more of an Australian influence, but certainly the way that I sort of grew up with property investment and hearing from the mentors and the experts
mhm,
was it's not something that you sell. You buy and you hold, and there might be a time where you retire and you're consolidating and you're selling there, but
yep,
there was at least a narrative of like selling should be the last resort, or a very clear part of your end game right at the end of your investing career. But you're kind of saying, look, there are times and places, maybe well before you're looking at retiring, that it is actually the best choice to sell a property because of the opportunities somewhere else where you can employ that capital.
absolutely, and that's correct, and that's why I was in New Zealand last week. So I had to see. It's important, even no matter how far your property is. I flew 3 hours because it's always good and important. Yes, you have great agents. Yes, you have photos. But then when I was there, I said like, yeah, mate. Looking at the economy, looking at the oversupply. Come on, you have 15,000 properties on the market and only 2,000 people to buy.
Mm.
And we did not know. Yes, the market is coming up. In fact, I heard a news about 1st of December rules changing in New Zealand regarding the LBR ratio. But
Mm.
how much effect is that going to have?
Mm.
So, yeah, consolidation. For me, if it was an overseas, I could not use equity. I knew that. But then I was able to, it was a great yield. 6.3% yield is coming up. I'm happy.
Yep. That's not
But
too bad.
then, not too bad, but then it's not growing. And in fact, the market has become very, very stagnant at the moment.
Yeah, yeah, yeah. When we sort of, I do want to unpack what you sort of referenced before with the acquisition, the consolidation, or let's just say the stabilization, and then the consolidation. But I feel like what maybe needs to preface that is the why of investing, and I know that's something that you lean to quite a bit. You talk about the why, and that
Mm,
you think it's quite overlooked, and I'm inclined to agree with you. So when you're sitting down with an investor for the first time, do you
yeah.
help them to figure out the why they're investing, not just what they want to buy or focusing on the hotspot?
Exactly, that's correct. So part of our journey is like when we do a discovery call is a quick 15, 20 minutes just to understanding what they're looking for. Are we even a match? Can we work together? What are their expectations? What do I look? It's important if they want to buy a agent. It's very important for me to also have a client whom we can work together.
Yep.
And my first question is, why do you want to invest? Okay, just because your friend is investing, just because great. So you're learning from him. but his journey, his financials, his risk-taking capacity is different to yours.
Mm.
And everybody will come with a common answer. Capital growth and wealth. Great.
Yep.
Is property investing only your option, or do you have other options of investments also?
Mhm.
So it's kind of then they understand what I'm trying to unpack over here. I'm not just here to, all right, let's go and buy a property. No, more than a buyer's agent, it's more as a property investment strategist. So what's your end goal? And then let's reverse engineer to reach over there.
Yep. And typically, what sort of end goal do people land on? Do they talk about having an unencumbered asset base of X at a time horizon, or is it all about the passive income that they're wanting to generate from property? I'm assuming that it differs, but from person to person. But is there one common kind of outcome? Is like, yeah, people want to have X at retirement, or they want to retire early with a passive income. How would you define those sort of end games? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
So I would break them into three segments.
Yep.
Some people come who are very unrealistic.
Yep.
Oh, when I retire, I want 40 grand a month. All right, great. Thanks. Then the other two types are very commonality when people are saying, hey, you know what, I'm tired in my 9 to 5 job. Maybe I just want to come a bit part-time. I can get some passive income. And they're realistic. They know it will not happen from day one. And the most common people are, hey, Rishi, you know what, we just want to have some property so that when we retire, we can have some source of income, or we can have some legacy for our kids.
Yep.
That is where I would say 70%, 80% of the people are who are very realistic. And at the same time, I also tell them, be realistic means if your affordability is, or you can have a borrowing capacity of 1 million, but what's your holding capacity?
Yep.
Holding capacity means the rent minus mortgage and expenses.
Yep.
If you can hold that, then yes, go for it. Because I don't want you to buy 4 properties and then what are you doing? There's no hope. There's no life balance over here. You're not going on holidays. You're just restricting your outings. You can't even eat properly. You're just eating, baked beans out of the can.
Mm.
So when we talk realistic, when they look at cash flows, then that is when they realize, oh yeah, you know what, there's too much of noise outside. Let's be more realistic. Let's get grounded.
I like that.
Yep.
And when you're having those conversations, do people typically have an answer to that kind of question on the why, or is it just something that's kind of like, oh yeah, well, I guess because broadly speaking, it's a good idea because you invest in something and it goes up, so you make more money.
It's half and half. Many of them have no clue.
Right.
And I really liked it because those people are really honest.
Yeah, yeah.
And no, we never thought about that. Oh, we have no clue. Oh, we've just been running real estate. Oh, okay, this. Oh, great. And then some people go, oh, yeah, I know that it happens like this. Yeah. So it's half and half. Some people understand the concept of passive income because they have seen some success stories. They have seen some friends growing, so they understand that concept. And some people do not know anything about it. And how can we work towards it? How can we create a portfolio in those terms?
Yep. So when we were talking about the structuring or the different phases, once you've got that sort of first or second property, the structure, of course, becomes really important. What's your advice on setting up a portfolio that can stand the test of time? Because you mentioned before about, the cost of holding onto it, so from a finance structuring and diversification and risk management and, making sure that you do have the buffers in place to be able to ride the properties long enough to get that growth. What does that look like to you? How do you describe that to your clients?
So when we understand either you're a first-time investor, that means you have a house and then you want to buy investment property, or you're just a rent investor. Mm-hmm. In those terms, we kind of, when we're making a portfolio strategy, or like, what's your end goal? I want 50,000 passive income or 100,000 passive income. That's before taxes. Great. let's work on it. We have got a portfolio mapping tool where we can enter some hypothetical scenarios, which gives us a constant growth of either 7%, or we can go hot market or warm markets, and which shows us the trajectory for the next on a compound growth for the next 10 to 15 years. So that tells them that we are more realistic. We need to buy one or two properties. For now, let's take it in phase by phase. So first question, portfolio. Now, at times you get stuck with the bank. You can't go with one, two, or three properties. Great. Having a chat with a client of mine, he's contemplating. He's got a good borrowing capacity. He's contemplating: shall I buy my own house or shall I buy two or three investment properties?
Yep.
He said, I'm not sure. I have to think. I said, how is your super? Oh, I've got money in SMSF. Great. So either you buy your own property or a rental under your name. Has nothing to do with SMSF. He said, that's correct. He said, all right, Rishi, let's start SMSF. In that time, that will give me clarity. Do I need to buy my own house, or do I continue to be a rent investor? So different options. With some people, we can tell them, oh, if your income is good, to save some tax. In fact, I'll ask you about some tax structure also. That you can even buy a property only under one person's name. You don't need it under two people's names, so you can have some tax benefits over there.
Yep.
So these are under your name, under SMSF, and then if you want to go more diversification, you want to buy under trust, these are some different options that you can work with. The other thing is risk. Whenever you have one property, and my client says, hey, I've got a saving of 100,000 or 150, or I can use this much equity, I'll tell them, mate, first of all, put at least 3 to 4 months worth of rent for each property aside.
Mm-hmm.
So let's say your mortgage is going maybe $2,000 or $3,000 a month. It means 3 into 3, so at least 10 to 12 grand. Just put it aside. Put it in your offset, put it anywhere. I'm not saying you're going to need it, but that is your safety buffer.
Yes.
So first of all, if you've got $100,000, you've got two properties, take 20 grand aside. Now you have $80,000. Now let's talk. This is your real base.
Yeah. Yep. Yeah. So it's just really avoiding people from getting into that situation, which I think is born in the stats of majority of investors still only owning one property. Is you want to, as you're growing, not put yourself in a position where if some unexpected expenses came up, you'd be forced to actually sell the property, and you may have only owned it for a year or two, haven't really achieved that growth cycle, or even if you have, we're talking stamp duty and selling costs that's probably eroded all of that gain, right?
Absolutely. I mean, people, I'll buy it, I'll sell it within a year. I said, yeah, mate, there are lots of expenses you need to take into consideration. Stamp duty, being the biggest, and with CGD, you're saving 50% on the profit, but then if you've done so much hard work to see what you want to do, you want to flip it, you want to hold it, you want to use the equity. We all have lots of options.
Yes. Yeah. So let's get to a specific area that I'm sure everyone is interested in, the market. From where you're sitting, where are the best performing regions in Australia right now, as much as you're happy to share your secret herbs and spices for where you're looking around the country? Or at least, if we're not talking about suburbs, what are the fundamental drivers that you're looking at?
I would have answered, Matt, that's my bread and butter. I can't tell that, but I'm happy to share it. Because no matter even, I can even share some suburbs. But the idea is, what I tell my clients, when you're going to buy a property, you're competing against other buyers like you. You're competing against other buyers who have done some course. You're competing other buyers who have a buyer's agent. And you're competing other people who are living there to buy a place for themselves.
Yep.
So you're pretty much at the rock bottom of the hierarchy. And to be on top, you need two very important things: a good network and time.
Yep.
Besides due diligence, that's all part of it. But if you don't have time, you can't do it. So if we talk about, let's start with New South Wales. There are really two great areas I would talk about in New South Wales that we see at the moment. That's Albury and Tamworth.
Yep.
Great. Why I'll talk? Because both of them have a great vacancy rate, approximately less than 2%, around 1.6 to 1.8% of vacancy rate. Days on the market, you understand like how quickly property is taking to sell. They're averaging less than around 35 days. Stock on market is very low. The funny thing is they both have grown around 10 to 12% in the last 1 year.
Yep.
There's a client of mine. We bought a property in Levington last year, and it's grown tremendously just within a year.
Yep.
In terms of population, it's got a good population, I would say, because Albury goes hand in hand with Albury Wodonga. So I would say around 100 to 120 K is the population. Tamworth, you might have to take east, west, north, all of them, they're hitting more than 70.
Yep.
Now, something I would like to talk about here, even though it's just not about all those things, it's about you have one of the biggest hospital in Albury that comes between Sydney and Melbourne.
Yep.
And there are other various projects. We're having resource projects over there, some hydrogen parks been coming there. So when you see there's investments, infrastructure happening over there, there's population, there's economic growth. So you can see all these things are the driving factor that affects a place. Like you get some big wind farms and renewable energy happening in Tamworth. So these are the things that population is growing. They're investing in transport and education. They're investing in medical facilities. So they're giving a nice infrastructure for people to live over there. And you are just not only one type of industry, the industry is also diversified.
Yep. And we've got inland rail there in the mix as well, I suppose, with, I think,
Yep.
I'm pretty sure Albury, Tamworth. I'm not sure if it goes exactly around Tamworth, but I mean, there's going to be a fair amount of industry and job creation on the back of that, and it won't be a million miles away.
Yeah. Similarly, see, there are different regions. We talk about Queensland, Townsville, my favorite,
Yep.
Mackay, Rockhampton. Again, vacancy rate less than 2%, days on market pretty low. The growth Townsville has immense 23%. Some areas like Douglas, they've grown more than almost hitting 30% now.
Mm.
And the thing is, it's been consistent for the past 3 years.
Yep.
That's the beauty about it. Population, Townsville is more than 200. And again, infrastructure, a lot in sports, renewable energy. Mackay has a hydrogen, coal, pumped hydrogen. So there are lots of infrastructure happening over there.
Mm.
Come to Victoria, we have great areas like Bendigo, Ballarat, Mildura, that's Greater Bendigo. Low vacancy rate, low days on market. The funny thing I'll tell you about here is Bendigo has had a growth of 6% in the past 1 year,
Mm-hmm.
as compared to only 3% in the last 3 years.
Right.
So
Interesting.
you can see what's happening.
Yeah.
Ballarat, 3%, as compared to -6 in the last 3 years.
Yep.
So you can see coming from minus to neutral, nothing, and then having a 3. And on top of them, Mildura, that's really going good.
Yep.
So these are some really, really great areas that we're helping our clients, and we can see some really good growth happening over there.
So when you're looking at growth, I mean, we talked about a couple of things that are maybe the short-term metrics, like the days on market, but the longer-term things that you've referenced is projects and investment infrastructure projects. So for long-term capital growth, what do we need to look at from a project's point of view? Are we looking for things that not only have job creation during construction, but also through the administration? For example, a road is great because you need people to build it, but once it's built, the maintenance is minimal. Whereas a hospital, lots of people to build, but then when it gets up and running, there's an argument to say, well, even more jobs are created.
Yeah, but the other thing, you just answered your question yourself. We're building a road, we need people to build the road. But hey, why will the government spend hundreds and thousands of dollars to build a road if nobody's going to use that?
True.
So they are people, so they are laying a foundation over there.
Yes.
If I go to a small regional town that has population maybe hardly 20,000 or 15,000, and if I see there's a Bunnings over there, I would definitely pick that up. That's a good green flag for me.
Yeah. I suppose in things like Bunnings, and there's a number of different examples. I mean, even just a new shopping centre going in, presumably somebody with way deeper research budgets and pockets than you or I has done the modelling to say this is growing or these are the population projections. So that can be, I presume, a pretty good thing to leverage.
Yeah, see, some of the things, as I said, when we look at migration, it's not only external migration, people coming from overseas, but also internal migration, how people are moving within the states and within the regions. A couple of years back, lots of people were moving from Sydney to Melbourne, we could see. because of the housing prices and affordability. Uh, Correct me if I'm wrong with the data. I think Melbourne has it's more populated than Sydney, but
Mhm.
Sydney is more expensive.
Yes.
So yes, population is also important, but hey, Melbourne is more populated than Sydney, but we can't beat the prices in Sydney at the moment.
Yes.
So we got to look besides how the infrastructure is there, what is the government intending to do in that area, what are the investments happening. Now, take the example of Darwin. There's a lot of infrastructure happening over there. There's a lot of people buying at the moment we have, but it's quite volatile at the same time.
Yes.
Some of my friends say, you know what, I'll just go sell it in 1 year and flip it out. I said, mate, there's a lot of hassle. You're investing, you're going to pay CGD, stamp duty. End of the day, if you're just going to make 20 grand out of it, do you think it's worth it? I
Yeah.
don't think so.
Not from a risk reward point of view, at least.
Absolutely, yeah.
And unless you do kind of think, okay, well, I'm going to have it for 3 years and it's going to do 50 or 60%, then, I
Mm,
mean, you can model it yourself and go, okay, well, these are the costs getting in. This is the capital gains tax. This is what I'd actually get based on my marginal rate, and then
yep,
selling costs and all that sort of stuff. One
yep.
thing that you mentioned that I wanted to pick up on, when you were sort of talking about sort of the hierarchy of buyers in a particular location. And given we've had an interest rate cut and the recent minutes have sort of said the policy is they define it as restrictive, it's given us a fairly good indication that we may see some more rate cuts down the track. At least sentiment is doing pretty well at the moment. But you mentioned connections and time, or relationships and
Yep.
time. So I wondered, I mean, the relationships, I suppose we're talking about the ability to access off markets. I wanted to know, a bit more meat on the bones for that one. But what are we talking about when we're referring to time?
So two things over here. When we're talking about relationship and network, it's about just not on the phone. We also visit those places. We meet with the agents. We talk to them. So we've got more than 50 agents throughout Australia that we work with. 80 to 90% of our properties are off market. That's a big number for us as compared
Yeah.
to hardly 40, 50% last year.
Yeah. Right.
So that's a big thanks to my team also, my acquisition specialist, and the relationship that I have and he has built in the last years.
Mhm.
And when we say time, now the moment if you all right, let's say you're also a great individual, you've also got a great relationship, you've got an off market. Great. Now, time is very important, which means at times we also miss out on properties. By the time we get back up, we've already got an offer.
Mhm.
So time in the essence is understanding that area from a macro level. Is that a great place to invest? Understanding that house from a due diligence, any defectors over there in terms of bushfire, flooding, uh, oversupply, housing commission.
Mhm.
Have you done all that? Then doing a comparable sales analysis. If they're asking for X amount of money, let's say 540, is it really worth it? Am I in that range? And what's my relationship? So that's all these takes time. By the time you do all these things,
Yes.
maybe the property's gone.
Yeah. And is that, I wonder, where you see the real competitive advantage for utilizing a buyer's agent? Or is that just, a couple of the things that buyer's agents bring to the table? Or do you actually kind of think, look, if you are wanting to transact in some of these heated markets where, the cat's out of the bag in terms of the fundamentals,
Mm.
it's that volume of deals that buyer's agents that can do that really adds value to the relationship? Because you could be as nice as pie to a real estate agent in a certain location and then genuinely want to help you. But if someone is equally nice and has done, 10 or 20 deals with them the last couple of months in a row, they're probably going to pick up the phone faster to that person than you.
It's not necessary. I've had a chat with agents. Maybe we have not done a deal in the past 2 months.
Mm-hmm.
And then I would call them, hey, how's it going? I just saw this property off market. Ah, we missed it. Hey, you know what? I have something for you.
Yeah. Okay. Interesting.
Sure, yeah.
Yep.
So great. At times, when you're also getting a lot of volume, it's not important that you have a great relationship with them because it's very transactional.
Yes.
And I work with my clients not on a transactional basis, it's more of a relationship basis.
Yep. Yep. So to kind of finish us off, I know that you focus a lot on the why of investing, the mindset, obviously the due diligence that you put into the research and the locations that you're transacting in. If you can tie all that in a bow, where do you kind of see the people that maybe inquire with you, or just a general observation of property investors? Where are we getting it wrong? Where are we stuck? What are the things that are making us miss out, or just that are getting us stuck in this inaction loop?
Couple of things over here. Let me try to remember what you all said. So, starting off, the kind of people who come to me, majority are first-time investors.
Mm-hmm.
Okay. There was this quote by one of another quote, like his statement was, "The only thing to invest in Australia is property. That's it."
Mm-hmm.
So, lots of them are first-time investors. A couple of them do come who have already got one or two investment, but they're stuck, or they have done kind of a costly mistake, which means they've done a wrong investment and the property is not growing at all, or they've bought somewhere in wrong, and then we help them out. So this is that. What is stopping from people? One of the podcasts I actually said earlier is that it's a lot of sentiments. You are investing approximately $500,000.
Mm-hmm.
So it's the fear of messing up than missing out.
Yep.
I have saved 120. What if I do a wrong investment?
Yep.
What if I miss it? It's that fear of messing up.
Mm.
I always tell to my clients, when you're buying a property, it's a business. Your deposit is your capex, your capital,
Mm-hmm.
and your ongoing maintenance is your operational expense.
Mm.
And you have to, before even going into business, have to understand what your risks are.
Yep.
All right? Will the area grow or not? The data will tell me, so I can mitigate that risk.
Mm-hmm.
Is the suburb clean or not? I'll do a due diligence that will clear my other risk. Will my property be rental or not? Hey, what's the vacancy rate over there? Or what's the location and how close is it? There's it. What if something comes wrong in the property? Pest in building.
Yep.
What if I don't get money? Finance clause. So at each step, there's a risk. Each risk is mitigated. We come down to a minimal residual risk, which
Yep.
we need to enter a business.
Yep.
Now, can I take that risk? Well, I'm putting 3 months worth of money aside. I'm covering my vacancy risk.
Mm.
That is how we educate our clients on that. And so it is kind of, they have heard a lot of horror stories and success stories. That also stops them. A lot of carrot dangling. Sorry to say that, but yes, a lot of carrot dangling from the government. We're coming with this scheme. We're coming with that. We're having this 5%. People don't have an understanding of the whole picture about it. And then they take a step back again by the time the market has moved on.
Yes. Yeah, look, I think what you've shared there is very, very valuable in the sense that if people are not taking action because they're worried about making a mistake, actually going and identifying, okay, well, let's look at what mistakes could be made, or let's look at the risks. And you've rattled off a couple of different ones, and we talked even prior about another one. Let's say, something breaks in the property that's not as significant as pest and building sort of stuff, but you're talking about the cash buffers as well. So once you, I suppose, isolate all those individual risks, you can decide, okay, well, what am I doing to mitigate it? And let's just say if we turn that up to 11, what's the worst that could happen? Then you might go, okay, well, even if that happened, which is very unlikely, I'm actually okay. I can work with it. So maybe it's forcing people to do that little bit of step-by-step work so that they can remove those barriers to actually get into the market. Because if we're talking about someone that's sitting on the sidelines, if we go back to the last couple of years, there's a lot of places in Australia, and I would say probably most, where there would have been some gains. And if people were sitting on the sidelines, in and around the beginning of COVID, they've potentially missed, 30 or 40% growth in a lot of markets from that point onwards, right? So I think that's a pretty powerful way to finish off, Rishi. So thank you very much for sharing that quite macro sort of look at property investing with some really actionable and great tips. And let's catch up in the future and see what's new for you and your portfolio as well.
No, definitely, man. Thanks a lot, Mike. And I would like to, catch up with you again to educate my clients on tax structures, tax benefits, how they can, tax depreciation, how we can help our clients. That would be really great to understand for them, bit of educational.
Yes, and we can lull them off to sleep if we do it in an evening session as well. I'm your guy for that. Thanks, Rishi.
Beautiful. Thanks, Mike. Thank you very
Cheers.
much. Have a great day. Bye.